Hello and welcome to the monthly recap. This is for the month ending today, August 29th, 2025. I know it's not officially the end of the month, but it's going to fall on a weekend. So here I am to you a couple days early. Hope you all had a wonderful month. The year is officially 2/3 of the way over, which is just absolutely mind boggling. Anyways, lots to get into. Gonna have a little bit of fun with this update, so hang in there with me. So, what's going on? Number one, keep calm. It's almost time. All right, we're going to be talking about the Fed meeting coming up in September. The Fed is finally going to cut rates. Thank all that is holy. It's been way too long. I'll talk about that in a little bit here. I want to talk about GDP. The numbers for the second quarter came in extremely hot, very, very hot, and actually got even hotter. Or is it really hot? We're going to be talking about that a little bit. The labor market and Trump are both saying the exact same thing. Talk about that. Inflation, a little bit of a mixed bag, somewhat predictably a mixed bag. But one big question mark kind of lingering over the inflation numbers, which is tariffs. What is going to happen with tariffs? And then we're going to go to Jackson. We're going to talk about the Jackson Hole Symposium that just wrapped up here. Mortgage rates ended the month right around 6.5%, 6.625%, right around that area for a first-time home buyer making less than 120% of the area median income. One of those kind of ideal scenarios. So let's get right into it. All right. So let's talk about GDP. Okay, so we got the second reading of quarter two GDP literally yesterday. Okay, and it came in a little bit warmer than the first reading. It came in at 3.3%. But if we look at the first quarter of GDP, it came in negative minus 0.5%. So quarter one minus 0.5, quarter two 3.3%. What the heck is going on? And Jerome Powell and the Fed, they acknowledged that the pull forward effect is in full swing. And what do they mean by that? Well, the very beginning of the year, right? Within weeks of the Trump presidency beginning, there was a number of tariffs that were announced. And with that, consumers rushed out and they bought a lot of stuff. Okay, they moved up their purchases. Hey, we weren't going to buy a car until the third quarter, maybe fourth quarter, maybe next year. And then the second everybody heard about tariffs, they ran into the market and they started gobbling up those goods. Okay. Shockingly, maybe not so shockingly, businesses did the exact same thing. They're like, look, we know things are going to get more expensive. We should stockpile right now. Let's get ahead of this. Let's stockpile right now. So they also started to buy goods. Well, when you look at the GDP calculations, it has to do with imports and exports. So people were buying a lot of stuff, businesses were stockpiling a lot of goods, but not a lot was being sold from those businesses, okay? So we had this pull forward effect occurring where people moved up their purchases earlier in the year. Fast forward to quarter two, and businesses started selling all those goods, and they weren't importing a lot anymore. Meanwhile, consumers stopped buying stuff as much because they had bought some of those larger purchases, especially the larger purchases in the first quarter. So this pull forward effect, both consumers and businesses moving their purchases up earlier to the year, and then the second quarter, business starting to sell some of that stockpiled goods, not having to import nearly as much. So they had this pull forward effect. Now, the Fed came out and said, look, it's not really fair to look at these numbers independently, okay? We have to really look at these numbers together because certainly things weren't as bad in the first quarter as the negative 0.5, and certainly they weren't as good as the 3.3% would show for the second quarter. So let's average those out together to get a real reflection of what the actual GDP is. That came in around 1.4%, which is okay, but not great. It's comic over here. The guess domestic product. Yeah, that's exactly it. Like they're pull forward effect, like all these things are kind of lurking in lockstep. It's really hard to kind of figure out what's going on. But it's fair to say the GDP is around 1.4%. What's going to be really interesting is when we get the first reading of quarter three GDP, is that pull forward effect still occurring? Has it slowed down? Are we going to get some real-time, realistic data going forward? Going to be really interesting. Next thing I want to talk about is the labor market. Okay, so BLS jobs report. This is the one that got a lot of headlines earlier in the month. It feels like a lifetime ago, but it happened literally just a few weeks ago. So the BLS report for July, Bureau of Labor Statistics report for July, showed only 73,000 job gains when the markets were expecting about 110,000 job gains. That's a miss. Okay, that's a hard stop. It's a miss. The unemployment rate did tick up to 4.2%. But it wasn't a huge miss, okay? But here's where the big miss was. Okay, so the prior two reports were both revised down by combined 258,000 jobs. The May report, if it had showed like real-time data at the time, that job report that showed 144,000 job gains would have only showed 19,000 job gains. 19,000. That is really, 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 really bad. June, those figures went from 147,000 to 14,000 job gains. Really big miss again, really bad numbers. I've been talking about how the BLS reports are really called the BS report because their numbers are just so wildly off. They do so much modeling and they take a small sample size and try to extrapolate that across like the entire US population to predict how many jobs are being created. They look at how many businesses are being born versus how many businesses are dying. And the problem there is like a lot of these companies are kind of like companies in name only. It's really hard to tell exactly how many people they actually had employed. So I've been talking about it for a while. BLS has been extremely unreliable. It should really be called the BS report. So Trump didn't like the jobs report either. Really, again, the miss itself, not terribly, but the revisions down, terrible, 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 terrible. Trump then decided to fire the head of BLS, Erica McIntapper. That happened literally just a few weeks ago. Again, it feels like it was months ago, but it was not. It literally happened in the last few weeks. So both Trump and the Bureau of Labor Statistics are saying, you're fired. BLS is saying, you're fired. There's not nearly as many job gains as it is. Trump is saying, you're fired. Erica McIntapper, you're gone. Sorry, deuces. So I try, I really, really try really hard to kind of avoid politics when it comes to my updates. If you ever want to talk politics with me, corner me, get me a couple drinks. I'll be happy to talk to you about it. But I try to avoid politics as much as I can. Certainly, changes had to happen at the BLS. I've been talking about that for a while. Their modeling systems, their polling systems, like all this is pretty bad. And when they have these gigantic revisions, it matters because the Fed is using this data to make broader economic decisions. So they have to have a reliable source of data. They have to have a single source of truth. And the single source of truth they've been using is BLS has been extremely inaccurate. So I do think that changes probably had to happen to the BLS. I think it was probably only a matter of time. But I honestly don't think firing one person is going to fix that either. They're really going to have to change like the underlying like process that the BLS operates under. And I don't know if firing one person is going to achieve that or not. Also, it's worth pointing out that one of Trump's points when he fired was, hey, this is getting too political. We think you're trying to hurt us. Well, that certainly hasn't been the case when they've been reporting these crazy good numbers all along. So that certainly hasn't hurt him either. So I'm not sure if I quite follow the logic that occurred. I do agree that changes probably had to happen to the BLS. And also, firing one person is in itself not going to change a whole lot. They're really going to have to change a lot more if they're going to get BLS to be a reliable source of data, which the Fed desperately, desperately, desperately needs. They can't make these gigantic decisions without a good source of truth. And BLS simply has not been that good source of truth for many, many, many years at this point. All right. That's about as political as I'm going to get. Even with this, some people are going to say, hey, you kind of lean this way. And some people are going to say, no, you kind of lean this way. Again, corner me with a couple drinks and I'll tell you the truth. All right. So let's look at the inflation data. It was a little bit of a mixed bag, somewhat predictably a mixed bag. Now, here's the bigger shock of the month was producer price index, PPI. Okay, producer price index. So we got that for July. The headline came in up 0.9%. Huge increase. Producer price index, again, is inflation as businesses feel it. Okay, so that was a big hot number, which is really not good. Yearly went from 2.4 to 3.3% on the headline, which is all in inflation. That's a huge move up. That is not great. The core also came in up 0.9%. The yearly figure went from 2.6 to 3.7. That core rate is with food and energy removed from the equation so that the markets aren't at the mercy of oil prices and avian bird flu and cost of eggs and all this other thing. Here's the good news. PPI, I talked about it before, it gets the least respect out of the three reports. It could be a leading indicator for other consumer level inflation, but it doesn't have to be. Businesses can deal with that increase of the cost of goods in numerous ways. They can just, shrink their margins, take it on the chin a little bit. They don't necessarily have to pass that higher cost off to the consumer. So it could be a leading indicator, but it doesn't have to be. That's why it gets less respect than the other two reports. Consumer price index, consumer level inflation, how we feel it. For July, the headline came in up 0.2%. Yearly remained stable at 2.7. Good news there. Core came in up 0.3%. The yearly went from 2.9 to 3.1%. Both these numbers actually were pretty much on target with what the market was expecting. So not a huge move. I debated putting this red number in yellow because it was kind of a neutral number, but it did tick up. I kind of had to acknowledge that. Personal consumption expenditures, PCE, that's the Fed's favorite measure of inflation. It also tries to measure consumer level inflation. And we got that report quite literally today, just a couple hours ago. These came in spot on with expectations. Okay, so the headline, again, all in, came in up 0.2%. The yearly remained stable at 2.6%. Good news there. Core, again, removing volatile food and energy from that equation, came in up 0.3%. The yearly went from 2.8 to 2.9%. All of that was exactly in line with the market expectations. And that's going to be really important in the next couple slides here. Give me just a couple seconds. So only other thing I really wanted to point out here is that more and more data shows businesses are splitting the cost of tariffs with consumers. The real question then becomes, how long? How long are they going to continue to do so? It's a good question. Businesses are not always just going to continue to split that cost. They're not always going to continue to shrink their margins. And for what it's worth, all this talk about trade deals occurring, there's been a lot of frameworks for trade deals, but there haven't been actually a lot of concrete trade deals still occurring yet. We have a lot of progress to be made on that. And until we do, tariffs are in full effect, and it's eventually going to start to pass along to consumers. So it is a real concern. It's something that the markets are very aware of, including the Fed, who's talked about it multiple times. All right. So it is going to be harder to make progress on inflation for the rest of the year. Now, we did just replace a small number with 0.17. And as you saw, there wasn't a huge increase in inflation. So we kind of dodged a bullet on this latest report that we got literally today. But going forward, August, so when we replace August report next month, that 0.17 is going to be replaced with probably a hotter number. Again, inflation is probably going to tick up slightly. Then we get to September and October. It's possible we actually make up a little bit of ground during these months. We need calm inflation. We need cooler inflation figures. But when we replace 0.25, if it comes in at 0.15, 0.2, we would see a small improvement in inflation. When you look at year over year numbers, one report gets added, one report drops off. So these are the reports that are going to be dropping off. A cool report is going to drop off next month. That's going to be bad for the inflation reports. Then slightly warmer figures the next 2 months. That could be good for inflation. But then we hit a couple really tame numbers, November and December. Then we finally get to the point when we're going to January and February, where we can finally, hopefully, start to make some meaningful progress on inflation. These were very hot reports. We will start to see improvement on inflation so long as tariffs don't get in the way. All right, so we're going to Jackson. Let's talk about Jackson. So every year, the Fed has a Jackson Hole Symposium. It's not an official meeting, okay? They do not make rate decisions. They do not change the Fed rate. To do so, they'd actually have to literally call a new Fed meeting, because the Jackson Hole Symposium is not one, and have an emergency meeting, which they don't do very frequently. So Jackson Hole Symposium, it's a meeting of Fed members, academics, market experts, the media, and their goal is to really discuss longer-term conditions, the strategy and the approach. They usually focus on the future, not so much on the present or the past. The exception being the last two Jackson Hole Symposiums, where the current economic conditions were so, for lack of a better term, severe that they really had to kind of discuss today more so than the future. It's not a formal meeting. Again, they won't make any rate decisions. They did not change the Fed funds rate, but it is followed by a speech from Jerome Powell. Okay, and the speech is really critically important. The Fed used that platform, Jackson Hole Symposium, literally 12 months ago as the basis to say, hey, look, we're going to start to cut rates. So they made that announcement literally a year ago, and sure enough, they started cutting rates after that. So it's not a formal meeting, but is a very important platform. To which, second verse, same as the first, Jerome Powell came out and spoke, and with it, they also alluded to a Fed rate cut in September. So yay, got some relief coming. Here's the exact quote. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. That is the most Fed speak of Fed speak of Fed speak, okay? What the heck does that mean? Let's take a look at it real fast. So with policy in restrictive territory, what they're saying there is with the Fed funds rate being elevated, okay? With the Fed funds rate being elevated, the baseline outlook and the shifting balance of risks. What's the shifting balance of risks? Well, the shifting balance of risk is the labor market. Yes, inflation is still elevated. They want core PCE to get down to 2%. Okay, and we're still well above that. But the shifting balance of risks, they're saying, look, we've been so focused on inflation, we need to start focusing on the labor market. And the labor market does not look nearly as strong as we thought it was. Proof of the pudding in there was the BLS report we got, where they took an axe to the numbers. They continue to get reports that show significantly weaker labor market conditions. Continuing unemployment claims being one, the unemployment rate taking up, the hiring rate going on with the JOLTS report, all point to underlying weakness within the labor market. Okay, so due to the shifting balance of risk, due to the issues with the labor market, we really need to start to consider changing our policy stance. Changing our policy stance means looking at cutting the Fed funds rate. So when's the next chance that they can do so? We don't have to wait too long. September 17th is the next Fed meeting. Not only is it an important meeting where they're going to cut rates, it's 90% plus chance that they're going to cut rates at that September 17th meeting. The vast majority opinion is that it would be 0.25%. 0.5% would be a surprise to the markets. But 0.25% rate cut likely on September 17th. This is also a meeting associated with a summary of economic projections, which is really good news for us. Again, I've talked about before how the Fed prefers to cut rates at those bigger meetings. And this is one of the 4 bigger meetings of the year. The reason they like to do so is because it also gives them a platform, not just to make a rate decision, but also to show their work. Where do we think the Fed funds rate is going to go from here? That's going to be very telling, because if they cut rates 0.25% and then they say, hey, look, we're also expecting another, 0.25%, 0.5% rate cut by the end of the year. That means the October and December meetings are both going to be really important. And it's likely the Fed's going to cut rates too. Again, inflation's going to tick up likely next month. So is that going to hurt them in their decision-making process? I would hope not. The Fed seems to be pretty aware of, we know what the conditions are, we know what we're up against, but they always keep talking about it and they keep circling back to tariffs. When is that finally going to come along and start to hit the inflation figures? Because it really hasn't hit yet. All right, so let's look ahead. Fed meeting, huzzah. Thank all that is holy for the Fed meeting and the inevitable, I'm going to call it inevitable. I'm going to speak this into existence, the inevitable rate cut that we're going to see. Now, what's going to happen to mortgage rates when that happens? Well, last time when the Fed began this rate cutting cycle, mortgage rates actually improved into that meeting and then actually increased slightly coming out of it. The market, it predicts what's going to happen. They start to kind of bake that into their figures. Rates start to improve. And then once the Fed makes a decision, like, great, we're going to start taking some profit from the markets and start to, remove some of that capital. But that meeting is going to be really important. Again, it's not just going to be a Fed rate cut. It's going to show where the market's going to, what the Fed's going to do from there on in, which is going to be very telling. Again, what is the additional guidance does the Fed give for the rest of the year? People are going to be looking at their GDP expectations, their unemployment expectations. Do they start to acknowledge a little bit more bluntly the concerns with the labor market? That'll be interesting because they have to also predict where they think the unemployment rate is going to go. Labor market, again, continues to show signs of weakness. Is that going to continue? Or is this Fed rate cut finally going to give businesses a little bit of relief so that they can start to hire more people? How long do businesses continue to absorb the impact of tariffs? It's a big question. It's a very big question. Tariffs are certainly in play right now. Businesses have so far been splitting that cost with the consumer because they don't want to lose a whole bunch of brand loyalty and customer loyalty. But they can only do so for so long. They have to report their earnings to the markets. They have to report to a board of directors. Like, how long can they really continue to absorb all those costs without starting to pass it along to the consumer? And then speaking of, again, trade deals. We've been talking about trade deals for all year. We've got a lot of frameworks of trade deals, but we haven't had a lot of concrete trade deals actually being worked out. Like, look, tariffs are going to continue to be a concern for the market until those trade deals are met, tariffs go away, and then the market's going to be like, oh, okay, we got it. We understand exactly what the conditions are. We know what we're up against, because tariffs right now are just a gigantic unknown, and that concerns people. So it'll be very interesting to see. All right. That is it. I hope you have a wonderful Labor Day weekend. Hope you have a wonderful long weekend. If you need anything at all, hit me up anytime. Thank you all so much for everything. Your referrals mean everything to me and my team. I say that, I've said that before, but seriously, everything to me and my team. It's tough out there. I know it is. Referrals really do mean everything to me and my team. So thank you all so very, very much for the continued support. And I will see you next time. Appreciate it. Bye.